You have been lied to. It is perhaps the most pervasive and dangerous lie ever sold to the ambitious, the intelligent, and the driven. It is a lie whispered in business schools, shouted from the stages of motivational seminars, and encoded into the very DNA of our culture. The lie is this: that your success is a direct function of your personal effort, that your hustle, your grind, your willingness to outwork the person next to you is the primary variable in the equation of wealth and achievement. You have been taught to worship at the altar of the grind, to believe in a universe where the scales are balanced, where merit is always rewarded, and where the sheer force of your will can bend reality to your ambition. This belief system, this mental operating system, feels righteous. It feels empowering. But it is a psychological prison, a cognitive cage meticulously designed to exhaust your resources, misdirect your focus, and ultimately guarantee your mediocrity. It is the hamster wheel of ambition, a beautifully decorated trap that rewards you with the feeling of progress while ensuring you never actually advance. It is engineered to make you a highly efficient cog in a machine you do not own, a powerful rower on a ship sailing in the wrong direction. The $90 billion fortune of Warren Buffett is not a testament to this lie. It is a monument to its complete and total demolition. His entire life's work, his staggering accumulation of capital and wisdom, stands as a brutal refutation of the hustle culture narrative. Buffett did not become one of the wealthiest humans in history by outworking everyone. He did it by mastering a hidden, almost invisible mental model, a deeply counterintuitive operating system that is his true secret. It is a system built on one foundational principle: the game you choose to play is infinitely more important than how well you play it. Before he ever analyzes a stock, a company, or an industry, Buffett first analyzes the system, the environment, the great unstoppable current in which that asset exists. He calls these currents tailwinds. These are not mere market trends. They are the monumental, multi-decade tidal waves of demography, technology, economics, and human nature that make certain outcomes virtually inevitable. While the rest of the world is focused on being the best swimmer, Buffett focuses all of his intellect on identifying the fastest-moving river. His genius is not in picking stocks. It is in picking systems that are structurally rigged for victory. He has architected a cognitive framework for making wealth creation automatic, a byproduct of aligning himself with forces so powerful that they overwhelm individual error, market volatility, and the efforts of any competitor. This is not a folksy aphorism. It is a replicable, systematic, and ruthless mental technology. We call it the Tailwind Protocol, and today we are going to deconstruct it. We will not just talk about this idea. We will dissect its cognitive architecture piece by piece. We will reveal the three core pillars of this hidden operating system: the inevitability filter, for identifying unstoppable demographic and economic currents; the capital flow compass, for aligning with the fundamental physics of the financial system; and the anti-fragility mandate, for selecting systems that are designed to feed on chaos and uncertainty. Prepare to have your most fundamental beliefs about work, ambition, and success challenged. Prepare to uninstall the virus of the grind and to install a new mental operating system, one designed not for effort, but for leverage. This is the deconstruction of Warren Buffett's system for automatic wealth creation. The first step in installing any new operating system is the complete and total uninstallation of the old one. We must first understand the psychological prison we inhabit before we can ever hope to escape it. This prison is the deeply ingrained, culturally celebrated myth of individual hustle. We must perform a diagnostic on our own minds to see the malware running in the background, consuming our cognitive resources and directing our actions towards low-leverage, high-effort activities. This is Part 1, The Great Deception. Welcome to the hamster wheel of ambition. It is a marvel of psychological engineering. It is polished, it gleams under the spotlights of our culture, and it feels incredibly satisfying to run on. Every stride, every drop of sweat feels like progress. The wheel spins faster and faster, and the digital display above it racks up impressive-looking numbers. Hours worked, emails sent, meetings attended, tasks completed. You are rewarded with the currency of busyness, the validation of exhaustion. You wear your lack of sleep as a badge of honor. You have been taught that this, right here, is the work. This is the path. But the fundamental, terrifying truth of the hamster wheel is that no matter how fast you run, your geographic location never changes. You are expending monumental amounts of energy to stay in precisely the same place. This is not just a metaphor. It is a precise description of the activity trap, a cognitive bias that plagues the most ambitious people on the planet. Our brains are hardwired with a powerful action bias, a deep-seated impulse to do something, anything, in the face of uncertainty. In our evolutionary past, this was a survival mechanism. The rustle in the grass was more safely met with immediate flight than with careful analysis. In the modern world of knowledge work and capital allocation, this same instinct is a catastrophic liability. It drives us to trade frantically in a volatile market, to constantly pivot business strategies before the old one has had time to mature, to fill every waking moment with work, because a pause for deep thought feels like laziness. We have come to equate action with progress and stillness with failure. The Protestant work ethic, a powerful cultural script embedded deep in the Western psyche, reinforces this. It bestows a moral virtue upon labor for its own sake. It teaches that hard work is not just a means to an end, but an end in itself, a sign of a righteous character. This cognitive script runs silently in the background of our decision-making, compelling us to choose the path of greater effort because it feels more virtuous, more deserving of success, even if a path of lesser effort would yield a far greater result. This is compounded by the illusion of control, another powerful cognitive bias. We systematically overestimate our ability to influence events. We believe that through sheer force of will and meticulous planning, we can control outcomes that are in reality dominated by randomness and external factors. The hustle narrative is the commercialization of this bias. It sells you the deeply appealing idea that you are the sole architect of your destiny, the captain of your soul. It minimizes the role of luck, environment, and systemic forces because doing so makes you feel powerful. And because you feel powerful, you keep running on the wheel, convinced that one more rotation, one more burst of speed, will be the one that finally breaks you free. But the wheel is designed to prevent freedom. It is a closed system. The energy you expend is the very thing that powers the illusion. Warren Buffett's mind is a fortress built against these biases. His entire career is a masterclass in the systematic avoidance of the hamster wheel. His legendary periods of inaction, where he famously sits in his office and reads for days on end, are not acts of laziness. They are the ultimate acts of cognitive discipline. He is consciously resisting the siren call of the action bias. He is deliberately choosing the stillness required for deep thought over the hollow satisfaction of frantic activity. He understands that in the game of capital allocation, one correct decision born from 100 hours of quiet contemplation is infinitely more valuable than 100 small decisions made in a flurry of unproductive work. He has successfully uninstalled the cultural script that equates effort with virtue. He feels no moral compulsion to be busy. His only compulsion is to be rational. His goal is not to feel productive. His goal is to *be tree twain. And he understands that the two are often inversely correlated. To begin the installation of the Tailwind Protocol, you must first come to terms with this brutal truth. You must be willing to question the very foundation of your ambition. You must find the courage to step off the wheel, even when everyone around you is running at full speed. You must learn to embrace strategic inaction, to cultivate the intellectual and emotional stillness that allows you to see the world not as a series of tasks to be completed, but as a complex system of currents to be navigated. The first act of liberation is to recognize the bars of your own cage. The cage is your addiction to the feeling of effort. The key is understanding that the goal is not to run faster. The goal is to find a better vehicle. The second layer of the Great Deception, and arguably the most powerful, is what I call the statistical tyranny of the starting line. It is the mathematical reality that Buffett refers to when he speaks of the ovarian lottery. This is not a philosophical concept. It is a cold, hard, quantitative fact. It is the single most important variable in the arc of a human life, and it is the one we are most psychologically resistant to acknowledging. In his 2014 letter to shareholders, Buffett wrote, "Charlie and I have been lucky. We were born in America, a huge tailwind. We've been awarded a combination of the ovarian lottery, the American system, and compound interest." Notice the sequence. The ovarian lottery comes first. It is the foundational layer. What does he mean by this? He means that the circumstances of your birth, the country, the era, the economic environment you are born into, are not small factors that give you a slight edge. They are the overwhelming, determinative factors that account for the vast majority of your potential success. Let us deconstruct this with brutal honesty. Imagine two individuals. Person A is born today in a developed Western nation with stable property rights, a robust legal system, access to quality education, and a dynamic, technologically advanced economy. Person B is born today in a war-torn, impoverished nation with corrupt institutions, no reliable infrastructure, and limited access to food and clean water. Both individuals are born with identical IQs, identical levels of ambition, and an identical work ethic. Who has a greater probability of accumulating significant wealth? The question is so obvious it feels absurd to even ask. The potential outcomes for Person A and Person B are not in the same universe. No amount of hustle from Person B can overcome the monumental, systemic disadvantages of their starting position. No amount of laziness from Person A can completely erase the enormous, unearned advantages of theirs. This is an extreme example, but the principle applies across the entire spectrum of human experience. Buffett understands this not as a matter of social justice, but as a matter of investment calculus. His decision to invest almost exclusively within the United States for the majority of his career was not an act of blind patriotism. It was a cold, rational calculation based on his analysis of the ovarian lottery. He recognized that being an investor in the United States during the 20th and early 21st centuries was like being a runner with a hurricane-force wind at your back. The American system itself was the greatest tailwind in human history. It was a system characterized by a culture of innovation, the rule of law, respect for property rights, a demographic explosion, and a deep, liquid capital market. An investor of average intelligence and average discipline, simply by participating in this system, by buying and holding a simple index of American businesses, would have achieved staggering wealth over the long term. The system itself did the heavy lifting. The Dow Jones Industrial Average began the 20th century at 66. It ended at 11,497. That is a 174-fold increase, not including dividends. A simple, passive investment would have turned $10,000 into $1.75 million. This was the tailwind. This was the automatic wealth creation engine. The average investor didn't need to be a genius. They didn't need to hustle 80 hours a week. They simply needed to be born in the right place at the right time and do one simple thing: buy a piece of the system and hold on. The great tragedy is that most people, even those who won the ovarian lottery, failed to capture this return. Why? Because they were distracted by the myth of individual effort. They believed they were smarter than the system. They tried to outwit the tailwind. They traded frantically, they chased hot tips, they paid exorbitant fees to managers who promised to beat the market. They were running on the hamster wheel, convinced their frantic activity would lead to a better outcome, all while the simple, powerful, automatic engine of the system was available to them for free. They chose effort over leverage. Buffett's genius was to recognize this dynamic with absolute clarity. He saw that his primary job was not to be a brilliant stock picker. His primary job was to fully and completely harness the power of the American tailwind. His individual stock picks were simply his method of choosing the strongest and most durable vessels to ride that powerful current. He was not trying to generate returns from a standstill. He was making concentrated bets on the best components of a system that was already rocketing forward. To internalize this is to fundamentally reframe your entire approach to wealth creation. You must stop asking, "How can I work harder?" and start asking, "What is the most powerful tailwind available to me, and how can I position myself directly in its path?" This question applies not only to your investments, but to your career, your choice of industry, your choice of location. Are you in a shrinking industry, fighting for a larger share of a smaller pie? Or are you in a growing industry, where a rising tide is lifting all boats? Are you in a company that is fighting against the current of technological change, or a company that is harnessing it? The starting line you choose, the system you decide to operate within, will determine 90% of your outcome. The hustle you apply will only ever account for the remaining 10%. This is the statistical reality. And it leads to the final, most deeply psychological piece of the puzzle. If this is so obviously true, why do our brains fight so hard to deny it? If the power of the system is so overwhelming, why are we, as a culture and as individuals, so pathologically obsessed with the myth of the heroic individual? This is the third and final layer of the great deception, the narrative fallacy. Our minds are not calculators, they are story processors. We do not understand the world through spreadsheets and statistical tables. We understand it through narratives, through stories with heroes, villains, challenges, and triumphs. The human brain is a meaning-making machine, and stories are the raw material of meaning. The story of the lone hero who overcomes impossible odds through sheer grit and determination is the most powerful, most resonant, most archetypal story in all of human culture. It is the story of David and Goliath, of the underdog, of the self-made man. This narrative is deeply satisfying to our psychological need for agency and justice. It tells us that the world is a fair and understandable place, a place where actions have predictable consequences. This is the cognitive bias known as the just world hypothesis. We have a deep-seated need to believe that people get what they deserve, and deserve what they get. The idea that success could be largely a product of random luck, the ovarian lottery, is profoundly disturbing to this belief system. It suggests a universe that is chaotic, unfair, and largely outside of our control. This is a terrifying thought, and our minds will perform stunning feats of intellectual gymnastics to avoid confronting it. So, we construct and consume narratives that reinforce our sense of control. We celebrate the billionaire entrepreneur and focus on their grueling work schedule and their brilliant insights, while conveniently ignoring the fact that they launched their software company during the explosive rise of the personal computer and the internet, the most powerful technological tailwind of the last century. We attribute their success entirely to their personal qualities, a classic example of the fundamental attribution error, where we overemphasize dispositional explanations for behavior while underemphasizing situational ones. Compounding this is the powerful effect of survivorship bias. We only study the winners. The media tells the stories of the handful of college dropouts who founded tech giants, creating the illusion that this is a common and replicable path. We never hear the stories of the millions of other college dropouts who failed. The successful survivors become the data points for our narratives, while the vast, silent graveyard of failures is ignored. The result is a profoundly distorted map of reality. We are navigating the world with a map that only shows the treasure chests and omits all the shipwrecks. We are led to believe that the path to success is a simple matter of following the hero's journey, when in fact, we are traversing a minefield where the vast majority of travelers perish. Warren Buffett's mind is ruthlessly disciplined against the narrative fallacy. He is a professional deconstructor of stories. When he analyzes a business, he is not interested in the charismatic CEO's inspiring vision or the company's glossy annual report. He is interested in the brutal, unsexy quantitative reality of its competitive position and its long-term economics. He is looking for the system, not the story. He famously said, "Buy a business so good that a fool can run it, because sooner or later one will." This is the ultimate anti-narrative statement. It completely dismisses the importance of the individual hero, the brilliant CEO, and places all the emphasis on the enduring quality of the system, the business itself, with its powerful economic moat. He has trained his brain to derive satisfaction not from compelling stories, but from objective reality. He has inverted the typical human preference. He finds beauty in a predictable, boring, cash-gushing business that is riding a demographic tailwind, while the average person is chasing the exciting, high-risk, narrative-driven story stock that is more likely to go to zero. To install the Tailwind Protocol, you must become a conscious dissenter from the dominant cultural narrative. You must train yourself to be skeptical of hero worship. You must learn to see the system behind the individual, the current behind the swimmer. This requires a profound intellectual humility. It requires you to acknowledge the enormous role that luck and environment have played in your own life, and will continue to play in your future. It means shifting your focus from trying to be the hero of a dramatic story to trying to be the rational owner of a boring, predictable, wealth-generating system. This is the work. This is the real grind. It is not the physical grind of sleepless nights, but the psychological grind of fighting your own cognitive biases, of resisting the siren song of compelling narratives, and of forcing yourself to see the world as it is, not as you wish it to be. Only when you have fully uninstalled this deceptive, three-layered operating system, the addiction to effort, the denial of systemic advantage, and the seduction of narrative, are you ready to begin the installation of its replacement. You are ready to learn the architecture of the Tailwind Protocol. Welcome to Part 2. We now begin the process of building. We will construct, pillar by pillar, the cognitive operating system that Warren Buffett uses to identify and harness the great unstoppable tailwinds of the world. This is not a collection of tips or tricks. This is a complete architectural blueprint for a new way of thinking, a system for seeing the invisible forces that shape our economic reality. The first and most foundational pillar of this system is what we call the inevitability filter. This is the mental machinery Buffett uses to identify and make massive, concentrated bets on unstoppable demographic and economic currents. He is not trying to predict the future. He is trying to identify the parts of the future that are already baked in, the outcomes that are so probable they are close to inevitable. He is looking for the glaciers, not the butterflies, the slow, massive, predictable forces that will crush everything in their path. The first and most crucial application of the inevitability filter is what we call the American default bet. Buffett's famous maxim, "Never bet against America," is often misinterpreted as a simplistic patriotic slogan. It is not. It is a deeply considered, coldly rational, system-level investment thesis. It is the conclusion of a rigorous analysis of America as a system, a wealth-generating engine. What are the components of this engine that Buffett identified? First, a culture of innovation and meritocracy that, while imperfect, consistently unleashes human potential on a scale rarely seen in history. Second, the rule of law and respect for property rights, which create a stable and predictable environment for capital to be deployed over the long term. Third, a demographic profile that, for 2 centuries, was characterized by robust growth, both from immigration and natural increase. And fourth, a deep, liquid, and relatively transparent capital market that allows for the efficient allocation of resources. Buffett looked at this combination of factors and concluded that the system itself was designed for success. It was a machine built to compound wealth. He understood that there would be terrifying interruptions, recessions, wars, market crashes, political crises, but that these were merely temporary glitches in a system whose fundamental trajectory was relentlessly upward. His bet was not on a particular president, a particular policy, or a particular decade. His bet was on the enduring structural advantages of the system itself. This is system-level thinking in its purest form. While others were panicking during the depths of the 2008 financial crisis, Buffett was publicly buying American stocks. His famous New York Times op-ed was titled, "Buy American, I Am." He wasn't predicting a quick recovery, he was simply reiterating his long-term thesis. He knew that the system, while severely damaged, was not broken. The tailwind, while temporarily stalled, would eventually resume. He was buying the system when it was on sale. How do you apply this? You must learn to analyze the country or region you are investing in as a system. Stop focusing on the daily political headlines and start focusing on the long-term structural components. Does the system respect property rights? Is the rule of law stable? Does the culture encourage innovation and risk-taking? What is the long-term demographic trajectory? These are the big, slow-moving questions that matter. You are not looking for a hot stock tip. You are looking for a winning system to operate within. The second application of the inevitability filter is what we can call the demographic engine. Demographics are the closest thing to destiny in the world of economics. They are slow-moving, highly predictable, and have enormous, non-negotiable consequences. Buffett is a master at thinking through these consequences. Consider the post-World War II baby boom in America. This was not a secret, it was a simple, observable fact. From 1946 to 1964, a massive cohort of babies was born. A thinker like Buffett would not just see this as a statistic. He would see it as a multi-decade economic tidal wave, with predictable stages. In the 1950s and 60s, this wave would drive demand for baby food, toys, and bigger houses. In the 1970s and 80s, as this cohort entered the workforce and formed households, it would drive demand for cars, apartments, and consumer goods. In the 1990s and 2000s, as they reached their peak earning years, it would drive demand for investment products, luxury goods, and healthcare. And in the 2010s and beyond, as they entered retirement, it would create an unprecedented demand for healthcare services, pharmaceuticals, and retirement living. Each stage was predictable. Each stage was a tailwind. Many of Buffett's most successful investments can be understood as bets on these obvious demographic waves. His investment in Coca-Cola was a bet on a growing global population becoming wealthier and adopting Western consumer habits. His investments in housing and related industries were bets on the non-negotiable need for household formation. His recent, massive investments in healthcare are a clear bet on the aging of the baby boomer generation. To think like Buffett, you must learn to read a census report like an investment prospectus. You must train yourself to see population pyramids not as dry academic charts but as roadmaps to the future. Where is the population growing? Where is it aging? Where is it moving? The answers to these questions reveal the great inevitable tailwinds of the coming decades. If a country has a rapidly aging population and a low birth rate, you can be virtually certain that demand for elder care, robotic assistance, and specific medical treatments will explode over the next 30 years. That is an inevitable future. Your job is to find the best-run, most competitively advantaged companies that are positioned to ride that wave. The system, the demographic destiny, provides the power. Your stock selection is just the sailboat you choose to harness it. The third application of the inevitability filter is what we might call the productivity miracle. This is a bet on a fundamental human trait, the relentless, irrepressible drive to find better, faster, and cheaper ways of doing things. It is a bet on human ingenuity. For 200 years, the story of the modern world has been a story of staggering productivity growth. From the steam engine to the internet, from the assembly line to artificial intelligence, we have been getting exponentially more output from the same amount of input. This is the ultimate tailwind. It is the force that has driven the stock market's upward trajectory, because corporate profits are, at their core, a share of this ever-expanding pie of productivity. Buffett understands this at a visceral level. When he buys a business, he is not just buying a collection of assets. He is buying a small piece of this ongoing human project of productivity enhancement. His purchase of the BNSF Railway was a bet that as long as human beings need to move physical goods from point A to point B, they will seek the most efficient way to do so. For heavy goods over long distances, that method is and will likely remain for a very long time rail. It is a bet on the physics of efficiency. His investments in technology companies like Apple are not just bets on a specific product. They are bets on a company that has become a primary platform for human productivity and connection in the 21st century. He is betting on the continuation of the trend. To apply this filter, you must learn to differentiate between fleeting technological fads and foundational productivity platforms. Ask yourself, does this technology or business make a fundamental process in the economy significantly more efficient? Does it reduce friction? Does it save time or resources on a massive scale? Companies that do this are harnessing the grand tailwind of human ingenuity. They are not just participating in the economy. They are accelerating it. The final application of the inevitability filter is the consumption imperative. This is a bet on the simple, predictable, and unchanging desires of human nature. While the world changes at a dizzying pace, the basic things people want remain remarkably constant. People want to feel good. They want to connect with others. They want to provide for their families. They want simple pleasures. Buffett's portfolio is filled with companies that cater to these timeless, inevitable demands. Coca-Cola is not a technology company. It is a company that sells a simple, consistent moment of pleasure for a very low price to billions of people every day. See's Candies sells happiness and nostalgia in a box. Geico sells peace of mind. These are not businesses that are going to be disrupted by the next hot startup. They are deeply entrenched in the simple, recurring patterns of human behavior. To think like Buffett, you must develop an eye for the things that don't change. In a world obsessed with disruption and innovation, the greatest competitive advantage can often be found in stability and permanence. What were people buying 50 years ago that they are still buying today and will likely be buying 50 years from now? The answer to that question points you toward the businesses built on the bedrock of human nature, the most powerful and predictable tailwind of all. This is the first pillar. The inevitability filter trains your mind to ignore the noise of the present and focus on the deep, structural currents that are already shaping the future. It is a system for replacing prediction with observation, for betting not on what might happen but on what must happen. The second pillar of the Tailwind Protocol is what we call the capital flow compass. If the first pillar is about identifying the great currents of the real economy, this second pillar is about understanding the physics of the financial system itself. It is about recognizing that money, like water, follows a path of least resistance, and its flow is governed by powerful, predictable forces. To be a successful investor is to be a master hydrologist of capital. You must understand the tides, the currents, and the reservoirs of the global financial system. The single most important concept in this domain, the North Star of the capital flow compass, is Buffett's understanding of interest rates as financial gravity. He has stated this many times. Interest rates are to asset prices what gravity is to matter. They are the fundamental force that holds the entire system together and determines the value of everything. When interest rates are very low, the gravitational pull on asset prices is weak. This allows prices to float up to dizzying, seemingly weightless heights. Stocks, bonds, real estate, cryptocurrencies, everything feels light and easy. Capital flows freely and taking risks is rewarded. When interest rates are high, the gravitational pull is immense. It presses down on the value of every asset. Future cash flows are discounted more heavily, making them worth less today. Capital becomes scarce and expensive. Risk is punished severely. This is not a complex theory. It is the simple mathematics of valuation. Every asset is worth the present value of its future cash flows. The interest rate is the primary variable in the denominator of that present value calculation. A higher rate means a higher denominator, which means a lower present value. Buffett's genius is not just in understanding this math, but in feeling it as an intuitive physical force. He does not see interest rates as an abstract government policy number. He sees them as the very climate, the atmospheric pressure of the investment world. This understanding prevents him from getting swept up in the speculative manias that low interest rates inevitably create. During the dot-com bubble of the late 1990s, when interest rates were relatively low and tech stocks were floating into the stratosphere, Buffett was famously on the sidelines. He was criticized for being old, out of touch, for not getting the new economy. But he wasn't looking at the stories, he was looking at the gravity. He saw companies with no earnings, no cash flow, being valued at billions of dollars. He knew that this was a low-gravity environment, and that when gravity inevitably returned to normal, these weightless assets would come crashing back to Earth. And they did. To apply this principle, you must train your mind to see interest rates not as a variable to be predicted, but as the fundamental context for all your decisions. When you evaluate a potential investment, the first question you should ask is not, "What is the story?" but "What is the prevailing level of financial gravity, and how does that affect the price I am being asked to pay for these future cash flows?" This grounds your analysis in reality. It forces you to think about valuation in a disciplined way, and provides a powerful antidote to the intoxicating narratives of bull markets. The second component of the capital flow compass is a nuanced understanding of the "don't fight the Fed" principle. For many traders, this is a short-term mantra for timing the market based on the Federal Reserve's latest announcement. For Buffett, it is a much deeper, system-level recognition of power. He understands that the entity that controls the currency, the very medium of the system, is the most powerful player on the board. You cannot have a sustained, long-term investment thesis that is predicated on fighting a direct, stated policy of a determined central bank. This is like trying to swim directly up a waterfall. Again, this is not about market timing, it's about risk assessment and system analysis. When a central bank embarks on a long-term policy of monetary easing, lowering rates and expanding the money supply, it is creating a powerful tailwind for asset owners. It is deliberately weakening the force of financial gravity. Acknowledging this does not mean you should speculate wildly. It means you should recognize that the system is being deliberately tilted in a certain direction. Conversely, when a central bank signals a long-term commitment to fighting inflation through monetary tightening, raising rates, it is creating a powerful headwind. It is deliberately increasing the force of financial gravity. Ignoring this force is an act of hubris. Buffett's massive cash pile at Berkshire Hathaway is, in part, a testament to this principle. In a low-gravity environment where he feels asset prices are too high, he is content to hold cash or short-term treasury bills and wait. He is not fighting the Fed's low-rate policy. He is simply refusing to participate in the resulting overvaluation it creates in other assets. He is respecting the power of the central bank by preparing for the day when its policy will inevitably change. Your task is to develop a deep respect for the power of these institutions. Do not try to outsmart them. Instead, strive to understand the direction of the current they are creating, and position yourself accordingly. This is not about active trading. It is about strategic positioning for the long term. The final element of the capital flow compass is seeing the government itself as an unseen business partner. Fiscal policy, the government's decisions about spending and taxation, creates massive capital flows that are as powerful as any economic trend. When a government decides to invest trillions of dollars in rebuilding its infrastructure, it is creating a guaranteed, multi-decade tailwind for companies in construction, materials, and engineering. When it decides to subsidize the transition to renewable energy, it is creating a powerful tailwind for companies in solar, wind, and battery technology. These are not speculative bets. They are alignments with massive, government-directed capital flows. Buffett is a master of this. His investment in the BNSF Railway was not just a bet on economic efficiency. It was also an implicit bet that the U.S. government would always have a vested interest in maintaining and utilizing its critical transportation infrastructure. His investments in the energy sector are, in part, a bet on the non-negotiable role that energy plays in national security and economic stability, ensuring a level of government support and predictable regulation. To activate this part of your compass, you must learn to read the national budget as a strategic document. Where is the government directing its capital? What are its long-term priorities? These are not political questions, they are investment questions. By identifying the sectors and industries that are aligned with these massive, state-sponsored capital flows, you are placing yourself in the path of a powerful, man-made tailwind. You are partnering with the largest economic actor in the system. This second pillar, the capital flow compass, provides the financial context for your decisions. It teaches you to see the invisible physics of the system, the gravity of interest rates, the currents of central bank policy, and the directed flows of government spending. It moves you from being a mere participant in the market to being a student of its fundamental structure. The third and final pillar of the Tailwind Protocol is the anti-fragility mandate. This is the most advanced and perhaps the most powerful component of the system. It moves beyond simply identifying and riding tailwinds to actively selecting for systems that are designed to strengthen in the face of chaos, disorder, and volatility. The concept of anti-fragility, popularized by the thinker Nassim Nicholas Taleb, describes things that gain from disorder. A fragile object, like a glass chalice, breaks under stress. A robust object, like a steel block, resists stress. An anti-fragile object, like the mythological Hydra, gets stronger from stress. When you cut off one head, two grow back. Buffett, long before the term was coined, built his entire empire on this principle. He has a deep intuitive understanding that the world is fundamentally unpredictable and prone to periodic crises. He knows that the tide will inevitably go out. His goal is not to predict when these crises will occur, but to build a system that is not only immune to them, but is designed to profit from them. The first and most profound application of this mandate is what we can call the insurance worldview. It is no coincidence that the core of Berkshire Hathaway, its foundational engine, is a collection of insurance companies. The insurance business is the ultimate model of anti-fragility. An insurance company gets paid a steady stream of cash, called premiums, every single day in exchange for a promise to pay out large sums in the event of a future, unpredictable catastrophe. For years, even decades, this cash piles up. This is the float, money the insurer holds but does not own. It is a source of cost-free, long-term capital that can be invested for the benefit of Berkshire shareholders. Then, a crisis occurs, a hurricane, an earthquake, a pandemic. The insurance company pays out claims. But a well-run insurer has priced its policies correctly, ensuring that over the long term, the premiums collected exceed the claims paid. More importantly, the crisis itself often strengthens the insurer's position. It drives weaker competitors out of business, and it allows the surviving insurers to raise their prices for the future, increasing their profitability. They get stronger from the shock. This business model shaped Buffett's entire psychology. He learned to love collecting cash up front and having the discipline to wait patiently for the inevitable moment of chaos. This worldview extends far beyond his insurance operations. He structures Berkshire Hathaway itself as a fortress, a financial system designed to be the last man standing in any crisis. His massive cash hoard is not a sign of indecision. It is a strategic reserve of ammunition, an anti-fragile tool. When the 2008 financial crisis hit, the entire global financial system was fragile and breaking. Banks were desperate for capital to survive. Berkshire Hathaway was not. It was anti-fragile. It had the cash. This allowed Buffett to step in and act as a lender of last resort, dictating incredibly favorable terms to giants like Goldman Sachs and Bank of America. He was not a seller in the panic. He was the buyer of last resort. The crisis was not a threat to him. It was his single greatest opportunity. He was strengthened by the disorder that was destroying everyone else. To apply the insurance worldview, you must change your relationship with cash and risk. The average person sees a large cash position as a drag on returns, an opportunity cost. The anti-fragile thinker sees it as a quote 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 a quote 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 quote. Saspel of Whiston Sabenta Little Milbusry. It is the price you pay for the ability to act decisively when everyone else is paralyzed by fear. You must begin to see market crashes not as disasters to be feared, but as rare, predictable opportunities to acquire high-quality assets at bargain prices. Your goal should be to structure your financial life in such a way that you become a net buyer of assets when the world is panicking. The second element of the anti-fragility mandate is a focus on what we can call the too-big-to-fail reality. This is a rational, unsentimental deconstruction of which systems are so critical to the functioning of society that they will not be allowed to collapse. This is not about cronyism, it is about systemic stability. Buffett's massive investments in America's largest banks, its primary railway system, BNSF, and its core energy infrastructure, Berkshire Hathaway Energy, are all bets on indispensable assets. A modern economy simply cannot function without a payment system, without the ability to move goods, and without electricity. These are the arteries and veins of the economic body. In a severe crisis, these systems are so essential that they become de facto backstopped by the government. They have a hidden insurance policy that other businesses do not. This makes them inherently less fragile and in some ways anti-fragile. The crisis that weakens them also reinforces their systemic importance, ensuring their survival and eventual recovery. To think this way requires you to look at the economy as an ecosystem. What are the keystone species? What are the components whose failure would cause a catastrophic cascade throughout the entire system? These are the areas where you find structural anti-fragility. This is not to say these companies are without risk, but their risk profile is fundamentally different from that of a company operating in a less critical sector. The final and most actionable part of the anti-fragility mandate is the principle of weaponizing pessimism. Buffett is often called an optimist, but it is more accurate to say he is a long-term optimist who is a brilliant short-term pessimist. He is acutely aware of everything that can go wrong. His concept of margin of safety is the ultimate tool of weaponized pessimism. It is the discipline of always paying a price that is significantly below your conservative estimate of a business's intrinsic value. This margin does not just protect you from being wrong in your analysis, it protects you from the unforeseen shocks and crises that are an inherent feature of the system. It is a buffer against a chaotic world. More importantly, Buffett uses the pessimism of others as his primary acquisition tool. A market panic is a wave of collective, irrational pessimism. It is a moment when people are willing to sell wonderful, productive assets for far less than they are worth because they have extrapolated a short-term crisis into a permanent state of ruin. Buffett's temperament, his emotional stability, allows him to remain rational while everyone else is losing their minds. He has structured his mind and his business to be a machine that calmly and systematically converts the public's fear into his own wealth. He is the cognitive counterparty to the market's emotional insanity. To apply this, you must cultivate intellectual and emotional detachment. You must do the work of valuing businesses before time of crisis, so that when the panic comes, you have a shopping list ready. You must train yourself to feel greed when others are fearful, and fear when others are greedy. This is the essence of building a mentally anti-fragile operating system. These three pillars, the inevitability filter, the capital flow compass, and the anti-fragility mandate, form the complete architecture of the Tailwind Protocol. It is a comprehensive system for seeing the world as it is, a complex interplay of powerful, long-term currents. It is a system for shifting your focus away from the high-effort, low-leverage game of trying to outwork everyone, and towards the low-effort, high-leverage game of aligning yourself with unstoppable forces. It is a blueprint for automatic wealth creation, not through get-rich-quick schemes, but through the disciplined, long-term harnessing of systemic power. But knowing the architecture is not enough. You must now learn how to install it in your own mind. This is the final and most critical step. This is part 3, installation and execution. The first and most difficult step of installation is what we must call the ego annihilation protocol. The single greatest barrier to adopting system-level thinking is your own ego. Your ego wants to be the hero. Your ego wants to believe that your success is due to your unique brilliance, your superior insights, your incredible work ethic. Your ego is addicted to the narrative of the heroic individual. The Tailwind Protocol requires you to deliberately and systematically dismantle this narrative. You must move from seeing yourself as the heroic actor to seeing yourself as the strategic, and often passive, system selector. This is a profound identity shift. You must learn to derive your satisfaction not from the feeling of effort, but from the elegance of a well-chosen system doing the work for you. One practical exercise is to perform what we call a luck audit. Sit down and list every significant advantage you have received in your life that you did not earn. Were you born in a stable country? Did you have access to education? Did you have parents who supported you? Were you born in an era of unprecedented technological and medical advancement? Be brutally honest and exhaustive. The purpose of this exercise is not to induce guilt, but to cultivate a profound and genuine intellectual humility. It is to force your brain to acknowledge the immense power of the tailwinds that have already benefited you. It is to internalize the reality of the ovarian lottery. Another exercise is to reframe your goal. Your goal is no longer to be a brilliant stock picker or to build a revolutionary company from scratch. Your new goal is to become the owner of the most robust, competitively advantaged, tailwind-driven systems I can find. This subtle shift in language has a powerful psychological effect. It moves your identity from doer to owner, from creator to allocator. It prioritizes wisdom and judgment over frantic activity. It is the first step toward annihilating the ego's need to be the hero of the story. The second stage of installation is to create a practical tool for applying this new operating system to your daily life. This tool is the system-level decision audit. This is a checklist of questions you must force yourself to answer before making any significant investment, career, or business decision. It is designed to pull your mind out of the weeds of short-term details and force it up to the 30,000-foot view of the system. The checklist includes questions derived directly from the three pillars. From the inevitability filter, what are the multi-decade demographic tailwinds that support this decision? What fundamental, unchanging human need does this address? Is this decision aligned with the long-term trend of human productivity and innovation? Is the underlying national or regional system I am betting on structurally sound? From the capital flow compass, what is the current level of financial gravity, interest rates, and how does it impact the valuation of this opportunity? What are the stated long-term policies of the relevant central bank, and am I fighting them or flowing with them? Are there any major government-directed capital flows that act as a tailwind or headwind for this decision? And from the anti-fragility mandate, how would this decision be affected by a sudden, severe market crisis or economic shock? Is it fragile, robust, or anti-fragile? Does it provide me with optionality, limited downside, and significant upside? Am I purchasing it with a sufficient margin of safety to protect against a chaotic and unpredictable future? Forcing yourself to write down the answers to these questions before you act is a powerful form of cognitive discipline. It slows you down. It interrupts the action bias. It replaces emotional, narrative-driven decision-making with a rational, system-level analysis. It is the practical implementation of your new mental operating system. Finally, we arrive at the ultimate application of this entire framework. It is the final inversion. The goal is not just to invest in tailwinds. The goal is to become the tailwind. This is how you apply the Tailwind Protocol to your own career and life path. You must stop thinking of your career as a ladder to be climbed through individual effort and start thinking of it as a vessel to be positioned in the fastest possible current. This means ruthlessly analyzing the industry you are in. Is it an industry with a powerful long-term tailwind, Or is it fighting against a headwind of technological disruption or demographic decline? It does not matter if you are the most talented professional in a dying industry. You are on a sinking ship. Your individual efforts are ultimately futile. The truly strategic career move is to identify the industries of the future, the ones being propelled forward by the great tailwinds we have discussed, and find a way to get on board. It is better to be an average performer in a spectacular industry than a spectacular performer in an average industry. The system's momentum will do more for your career than your individual hustle ever could. Position yourself inside a company that is itself a powerful, anti-fragile system with a deep economic moat. Join the winning team. Let its success become your success. This is the ultimate leverage. You are no longer just a rower, expending all your energy to move the boat. You have become the wind itself, part of the force that propels the entire system forward. Your personal success becomes an inevitable byproduct of the larger system's unstoppable momentum. You have achieved automatic wealth creation, not just in your portfolio, but in your life. You have escaped the hamster wheel. You have uninstalled the Great Deception. You have installed the Tailwind Protocol. You now possess the architectural plans for the Tailwind Protocol, the master framework for shifting your focus from how hard you work to which current you're swimming in. You understand that selecting the right game, the right system, is the ultimate form of leverage, the master skill of wealth creation. But this reveals the final operational question. How do you filter the infinite noise of the global economy, the daily news, the market fluctuations, the expert opinions, to actually perceive these multi-decade tailwinds with the clarity of a Warren Buffett? Having the map is one thing. Being able to read the terrain is another. The ability to transform raw information into a coherent, wealth-generating worldview is not a gift. It is a learned skill, a cognitive machine you must build. That machine is what we deconstruct in our next documentary, Buffett's Cognitive Compounding Engine. It is the exact system he uses to process 500 pages a day and turn knowledge into an unassailable fortress of wealth. To begin the installation of that engine and take the essential next step in this journey, click the video now appearing on your screen.